Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. I'm bringing this conversation with a guest who's really well researched on the macro and the micro, with a disclaimer that a lot of conversations and a lot of opinions might sound extremely dated just 6 hours into those conversations because of the fast changing situation on the geopolitical front at least. But with that disclaimer, let me welcome Dhananjay Sinha. He's MD and head of strategy at JM Financial Institutional Equities, and he joins us right now on the show. Dhananjay, good having you. Thanks for joining in.
Well, thank you, Neeraj. Nice to join again on your show.
Yeah, also an important juncture to do this. So, Dhananjay,
Right.
Can we start off with what has been an advice that you would have given in your strategy note to your institutional clients in a time which is marred by this geopolitical events and the fast changing scenario backdrop, so to say?
So the thing is that the strategy sort of reports that we've been talking about and the research and advice that we've been given to people is of a continuous caution for the last, I would say, 3 to 6 months time. So because we could see that there is a convergence of multiple inflection points from a global standpoint, be it with respect to global liquidity rates, capital flows into India, and also the way the growth would pan out. So I think there are multiple things that were happening. And so we were looking at a slower growth in the second half of financial year 2023, etc. So I think we were kind of cautious, and we have been talking about, in advance that one should actually be getting more careful about deep cyclicals. We've talked about, the investment cycle, not people being very optimistic about it. We've been talking about banking sector, mid and small cap, all those things were there. So we have been guarding people against that. I think what has happened with this kind of geopolitical risk that is happening with the Russian incursion into Ukraine, essentially is actually, scaling up the level of risk and the vulnerability that we have been talking about. So I think with respect to the direct impact of the incursion, I think what would be important is what happens to the cost side, especially with respect to oil and gas prices, etc. And I think this is not new. Actually, this was first seen in October 2021. And I think this problem with respect to the Russian supply of gas and then sudden skyrocketing of gas prices and stagflationary issues with respect to rising crude prices were all visible in October itself. What has happened is actually aggravated now. So my sense is that all that we've been saying for the last 6 odd months, 5-6 months, will get accentuated as we move forward. And the difference that is happening now is that you have a geopolitical risk, a possibility of further scaling up of oil prices. One can expect it to go up to 110, 120 is what I guess can happen if the sanctions on oil exports from Russia actually fructify. And you have, for the US Fed, the window is actually closing, very narrow, getting very narrow with respect to their normalization thing that is expected. So I think all these things are actually coming together, and hence that is actually a concern for the markets, and hence the risk premium is actually going up, and the volatility risk is also rising. So I think that's the context for the markets, and we have been advising people to be more defensive, we'll be less on high beta names and be cautious. So I think that's what we have been telling people.
Dhananjay, could in the backdrop of the war, the conflict being a known risk now, right, but a bit of an unpredictable one, but also the point that there are 3 large events, so to say, including the UP elections, the Fed meet, and the LIC IPO in the month of March. Would you reckon that while valuations may be a bit more sanguine compared to the all-time highs, the markets would continue to stay range-bound with a downward bias? Of course, this is presuming that the conflict situation doesn't worsen from where it is right now.
So the way to really look at it is that you have these three events and stuff. So there is an event thing, and there is a more fundamental view as well, right? So with respect to event, I would say that what this conflict is doing, you can have various scenarios. One is that this gets into a more serious military and armed conflict between the West and Russia, and those kind of things can happen. I think that can actually increase the uncertainty. It can actually increase the supply chain issues that the world has been facing, especially in Europe, and that actually can be fairly disruptive. The second scenario could be that there be some dialogue and some withdrawal happens, etc. That can happen. So I think that can be a sort of a certain that can induce a certain amount of comfort. But the thing is that overall, we are of the view that eventually the Russian intent is actually very clear. They want to expand, and they want to be expansionist, I would say. And I think what can happen after that is that with China and US actually China and Russia coming together, there can be a greater trend towards expansionism after this conflict. So I think what happens in Taiwan, what happens with Indo-China sort of the border dispute, all those things will actually come into the frame. So I think there are multiple fallouts from this geopolitical.
But which are not necessarily predictable, Dhananjay. So would you therefore believe that the bias might remain downwards?
Yes, of course. So the thing is, that is one. So the thing is that one, that uncertainty with respect to this conflict and how it pans out is unknown, and hence the market would not really be liking this, especially when, despite the fact that you have about 10 or 15% correction from the peak, it's still very expensive. So I think the valuations are expensive. So and you have a situation where the volatility variables are still suppressed, I would say, and there is a possibility of that rising as well. So I think that uncertainty and volatility itself could actually translate into lower multiples. So that's number one. Number two, I would say that I'm not too sure what happens after the UP election, whether that is really important. So the thing is, there can be certain things with respect to how governments would behave with respect to farm laws or other reforms, etc., whether they will be more populist and all those things are relevant. But I think from a government standpoint, we already know that the budget has been very, very conservative. There has been an expansion of 4.6% in total spending. In real terms, that will be negative. And hence, the support from the government from a demand standpoint is actually very weak or possibly negative. So what would happen is that eventually it's the private household and the companies, they will decide what kind of growth will it be and what kind of trajectory will that be. And at this juncture, it's actually very modest. Thirdly, I would say that what we are looking at is a considerable downgrade in terms of the earnings estimates. So currently, the consensus estimate for Nifty is about 18 to 20% for FY23 and FY24. And in a scenario where the real GDP growth is expected to verge or sort of verge into a range of 4.2, 4.5%, as has been projected by the RBI in the second half of by 23. And I think we are also of the opinion that structurally we are veering towards 4 to 5% kind of growth. So it's quite likely that earnings might actually be downgraded. And so all those things are relevant. So you have a concern with respect to earnings, and you will have a concern with respect to multiples because of the global factors of geopolitics, and also the fact that the window of opportunity for the Fed to normalize rates is actually running out, and they will need to react more aggressively. So I think those are the things, with respect to earnings. I just wanted to add one more point is that we are actually, look at 2008 to 2019, which is the pre-COVID period, the average earnings growth for Nifty is about 6.7%. And real GDP growth is also about the same level, so somewhere around 7%. So essentially, if you have a structural GDP trajectory in the region of 4 to 5%, and your expectation is of 20% growth on top of 40% growth in FY23, I think it's a very tall ask. So I think there will be multiple normalizations that will happen, on multiples, on liquidity and earnings as well. So I think broadly, hence I would say the downside bias is there. We're looking at a downside risk, downside level of 15,000 for Nifty. We'll scale it down from 16,500 earlier.
15,000 for the Nifty. Okay, so that's part one, and whenever it happens. But I think it's a very fair point, Dhananjay. There's a potent cocktail if indeed the multiples are to derate, which look likely, and if earnings estimates are going to get hampered. So let me first get the tough, the themes which will face the wrath, if you will, and everything which is commodity input, I reckon, could be the ones which could face large earning issues. Right now, my question to you, Dhananjay, out there is only one. There are certain pockets like chemicals, for example, which are trading at premium valuations and might have the input cost pressures versus, for example, autos, that as one basket, which will have commodity price inflation pressures, but the valuations are not very steep. And there will be other examples. So how do you approach the commodity input impacted themes?
So I think what is happening is, there is one input which is basically crude oil, and the other part is, so crude oil and the impact of that on fuel prices has a broader impact on the economy. It sort of impacts multiple sectors. It could be by way of higher logistics cost, transportation cost, packaging, etc. So there is a sort of a multi-dimensional effect of rising crude prices. And I guess what will happen is that after the state elections, the government might actually initiate further price hikes as far as diesel and petrol prices are concerned, and also gas. So I think the vulnerability of various sectors with respect to input costs is going to be fairly high. So what we have done is really gone back into 2011 to 2014, 15. So what we had that time is that the crude fell in 2009 to about $60, and then rebounded to 110, 120 level range. So as the economy recovered because of the stimulus, etc. But I think somewhere around 2011, 12, as it remained around 110 or something like that, or that range, 110, 120, we could see that we saw that there was margin pressure, and the demand was actually slackening. So essentially, we can draw upon the past experience and see what happened, what can potentially happen. So based on that, what we find is that sectors such as industrials, basically including also a lot of cap goods stocks and companies, infrastructure, cement sector, and those are the sectors that are more vulnerable to rising fuel price inflation, and also generally the raw material costs. So that is there. Autos also get impacted, real estate get impacted, and telecoms. These are the sectors that got impacted at that point of time. So the way to really look at is that while there is one side of the pack which is basically impacted by rising fuel prices, the other pack is also with respect to other input costs such as metal, etc. So over there, if you look at autos essentially for them more relevant is steel price, etc. And we have seen that global steel prices have actually corrected. So if you look at US, it's corrected by 35%. Europe is also corrected by 30-odd%. China also corrected. So I think what one can really look at is with respect to autos that as far as the steel prices are concerned, the likelihood of that actually normalizing is higher. Though there has been some rise in cost recently, but my sense is that the outlook for steel sector, steel demand in particular, is fairly weak, I would say. So secondly, I would say with respect to semiconductors and all, one is expecting better supplies and all. So I think there are certain positive triggers that are there. The volume growth has been very modest, so it's likely to improve, etc. Because we think that eventually the urban sector should actually revive first, because we do not think the rural sector could actually be fairly modest, where can remain very weak. So I think we are relying a lot on the urban recovery, and within that, the auto sector can see some improvement. So I think with respect to valuation and all the other triggers that are there, I think the auto sector has reasonable valuation to really look at. So I think any correction and all, one can really look at that. Yeah.
Okay, in terms of a correction. What about oil upstream on the other side? Almost everybody seems to be now saying that with the average prices being judged in for 2022, companies like Oil India and ONGC seem to be prime place from an investment perspective. Would you second that?
So yeah, I think, I don't know whether it is an investment thing, but I think definitely it is a good trade, I would say, because, upstream companies would actually benefit from rising crude prices. It betters their margins, etc. So I think ONGC and all definitely figure there in our list of stocks. So I think definitely we would take an opportunistic view and consider that as a good positioning in the short term, I would say.
So Dhananjay Sinha, what are you constructive on? You are rightly so sounding cautious on the macro. You said that the multiple and the earnings downgrade leads you to downgrade your Nifty target as well.
Right.
That's a scenario. What can withstand the pressure, or what can outperform?
So the way we are looking at is that sectors that are typically. So what we have done is we have looked at the impact of volatility in oil prices, how various sectors have done in the past, and looked at those sectors, and also looked at in the past 30 years when liquidity normalization happened, because that is also another thing that would happen in the next 6 to 12 months' time. So I think we have actually juxtaposed these two scenarios together. So with respect to the volatility in commodity prices, and especially the crude oil prices and the impact on fuel costs in India, I think sectors that seem to be doing relatively better are private banks, consumer staples, pharma, utility, upstream, oil companies, as I just said, and IT. So these are the sectors that typically did well. I would say that if you look at the past history of normalization, also in terms of liquidity, some of the sectors actually that I've mentioned with respect to sensitivity to crude prices and higher raw material costs also mimic the sectors that could do better in terms of or the sensitivity is similar with respect to the global liquidity normalization. And here, what we have highlighted is that during normalization phase, sectors that are more volatile are metals, PSU banks, realty, infrastructure, cap goods, construction space, and mid and small cap. So these are the sectors that are there high on my exclusion list. And sectors that are relatively better, if you look at the liquidity normalization phase, it's autos or household products, personal products, hotel, restaurants, durables, etc. So I think the way we are sort of positioning our portfolio essentially characterizes these trends. It's not necessary that these will necessarily follow, but this forms a bulk of my portfolio construct. So essentially, sectors that we are overweight at this juncture are stocks within the auto space. We still believe that IT has been expensive, but I think there can be correction and all. And I think the visibility in terms of revenue, earnings, etc., is still pretty good. So I think with the correction, which has been very steep, I would say, over the last 1 month or so, IT stocks can be looked at. Thirdly, I would say that we are relying a lot on urban recovery, because I think from a domestic play standpoint, if the banks are not able to lend enough, then it's likely to be focused a lot on private banks who are gaining market share, etc., who are better asset liability management. So my leaning is more towards private banks. I do not see private capex happening, and we have been saying this since, I would say, September, October last year. So private capex is not something that we are very gung-ho about, as generally market has been. So that's a non-consensus view. With the kind of disturbances that we are seeing today, it's more more likely to be the case that capex or private capex will be fairly modest. And I would say from a government standpoint also, while there is a sort of higher allocation in the budget, but if you really do the fine print analysis, I think the underlying growth is fairly modest. I think it's about 6% on. So I think the capital goods is something that I would say is not something I've been very favorable about. So I think there I would say from a banking sector standpoint, this whole play about industrial lending, especially for PSU banks, etc., is unlikely to happen. So my whole context is that if government is not very supportive, global trade in terms of merchandise is not very supportive, and capex doesn't happen, then it has to be the urban consumption, because I would say that the support to the rural spending is also coming down. If you look at the budget, there is almost like a 24% reduction in various subsidy and Manrega, etc. Overall, support to the rural and agri put together is actually coming down by almost like 70% if you look at the central budget. So it has to be urban themes. It has to be urban consumption. So that way, that is the reason we have overweight on auto, especially the urban themes, and also I would say durables. Here also we are a little bit overweight. And in terms of real estate, there can be volatility, but I would say that one can look at certain stocks there, especially the large cap ones. So essentially, the core theme is that you have to be in large cap space. I'm saying that you need to prune down your mid and small cap exposure, because the illiquidity risk is not priced in, and hence there can be significant impairment as far as value is concerned.
Okay. Dhananjay, out of time, but very quickly, quick 1 minute view, if you can, on the currency. Yeah. Do you expect the rupee to depreciate over the course of the year?
So we think that rupee should be depreciating on an RER basis. It's overvalued by about 7 to 8%. And I think what RBI is really doing is to really protect it, and they are selling dollars to defend it. So it's been in the range of 74, 75. But I think that is actually translating into tighter liquidity and higher yields. I think it's a difficult situation or a tricky situation for RBI. I think eventually they will allow the rupee to depreciate, and we're looking at 80 to $1.
Wow. Okay. Dhananjay Sinha, really appreciate you giving us a complete synopsis of what the strategy in your mind is. Thank you so much for taking the time out today.
Thank you very much.
Bye. Viewers, thanks for tuning in.